There is a relationship on Wall Street that the big banks would rather you never learn to read, because once you can read it, half of what the financial channels tell you falls apart. It is not a stock, it is not a fund, it is a ratio, a quiet number that measures the whole stock market against a single ounce of gold. And it has been swinging back and forth across the decades in a rhythm so steady, it almost feels like a law of nature. Most people have never heard of it. The desks that trade for a living have watched it their entire careers. If you are a retiree with your savings tied up in stocks and funds right now, this matters to you more than almost anything a talking head will tell you this year. Because that swinging number is telling you where you are standing in a cycle that is older than you are. And where you are standing decides whether the next stretch of years rewards the money in the market or the money in metal. I am not going to hand you a price and a date. Nobody honest can. But by the end of this, you will understand the one measurement the smart money uses to know which side of that long cycle we are on, and you will be able to check it yourself for the rest of your life. So let me give you the concrete piece right up front, because you have earned it in the first minute. Take the entire Dow Jones Industrial Average and divide it by the price of 1 ounce of gold. That gives you a single number, and that number tells you how many ounces of gold it takes to buy the whole Dow. Here is the part that matters. Over the last half century, that number has not drifted randomly. It has traveled in enormous, sweeping arcs. It fell to somewhere near 1 at the great gold peak at the start of the 1980s, when an ounce of gold and the entire Dow were priced within shouting distance of each other. And it soared to something wildly high, into the double digits and beyond, at the great stock mania at the turn of the millennium, when stocks were king and gold was a punchline. That is the whole story in one line. Stocks and gold trade places, and they do it on a clock measured in decades, not days. Now, why does almost nobody talk about this? Ask who benefits from you not knowing it. The firms that make their living selling you stocks and funds have no interest in you looking at a chart that says, in plain arithmetic, that there are long seasons when the market is expensive against gold, and long seasons when it is cheap. That chart does not sell you the next hot fund. It does not fill a trading desk with commissions. It just quietly tells the truth. And the truth is inconvenient to an industry built on keeping you fully invested in paper at all times. So the ratio stays in the back room, and you get the noise. Let me walk you through the rhythm, because once you see it, you cannot unsee it. Go back to the middle of the last century. Coming out of the post-war years, the stock market was modest, and gold was pinned by law at a fixed price. Then, through the 1960s and into the 70s, the whole arrangement that pinned the dollar to gold came apart. The system that had tied the world's currencies to a gold-backed dollar was abandoned in the early 70s. The president closed the gold window and called it temporary, and it was never reversed. And gold, freed at last, began one of the most violent bull markets in financial history, climbing from the mid-30s in dollars, all the way to over 800 by the end of that decade. A 20-fold plus move across a single decade. And here is what that did to our ratio. As gold exploded upward and stocks languished through a decade of inflation and malaise, the number collapsed. It fell and fell until, at the frenzy at the top of that gold market, it came down near 1. Think about what that means in human terms. There was a moment when the price of a single ounce of gold and the price of the entire industrial stock market were nearly the same figure. Gold had become so beloved and stocks so despised that the metal briefly stood toe-to-toe with the whole market. That is what the bottom of the cycle looks like for stocks and the top of the cycle looks like for gold. Then the wheel turned, the way it always does. Through the 80s and 90s, gold went to sleep and stocks came roaring to life. A whole generation of investors grew up believing that stocks only ever went up and gold was a relic your grandfather worried about. The financial media crowned the market, and our ratio climbed and climbed and climbed until at the great mania at the turn of the millennium, it reached a towering height. It took a huge stack of gold ounces to buy the Dow then. Stocks had never been more expensive measured against real metal. And that, precisely that, was the top of the cycle for stocks and the bottom of the cycle for gold, even though at the time it felt like gold was finished forever. I want you to sit with how backwards that feels, because this is the heart of it. At the moment gold felt most hopeless, it was cheapest against stocks, and it went on to multiply many times over the years that followed. At the moment stocks felt invincible, they were most expensive against gold, and the decade that followed was a hard one for the market. The feeling and the reality run in opposite directions. When the crowd is most certain, the cycle is usually closest to turning. And the only instrument that would have told you the truth in real time was that quiet ratio nobody wanted you to watch. Now, before I go further, I want to speak directly to the person this affects the most, because there is something you can actually do about all of this, and almost nobody will tell you it exists. If you are a retiree sitting on $100,000 or more in a 401k or an IRA, here's a fact that ought to be on the front page and never is. The central banks of the world, the most powerful and best-informed buyers of gold on the planet, have been buying it at a record pace, clearing more than 1,000 tons a year for 3 years running, roughly double what they bought the decade before. They are quietly moving out of paper promises and into metal they can hold in their own vaults. And there is a perfectly legal, perfectly ordinary way for you to do the same thing inside the retirement account you already have. You can move a portion of that savings into physical gold and silver, real metal, without triggering taxes and without triggering penalties, through what is called a self-directed precious metals IRA. This is not some exotic loophole for insiders. If you have that 100,000 or more in any retirement account, this is available to you. I put together a free guide that walks through exactly how it works. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. It costs you nothing, and understanding your options is the whole point. Now let me take you back to the cycle, because the story does not stop at the millennium. From that towering top, the ratio began falling again through the 2000s, as gold woke up and the market ran into trouble. And along the way it taught us something crucial about how these turns actually feel, which is that they are never a clean straight line. The ratio does not glide smoothly from one extreme to the other. It lurches. There are stretches inside a gold season where the metal drops hard and fast, where the leveraged paper crowd rushes for the exits all at once, and where every headline insists the story is finished at the very moment it is only pausing for breath. If you had watched one of those drops and concluded gold had failed, you would have sold at the worst possible moment, right before the ratio resumed its long grind down. And this pattern of paper failing where metal holds is older than most people realize. Go all the way back to the 1930s, when the government revalued the dollar price of gold overnight by decree, lifting it from just under $21 to $35 in a single stroke. Ordinary savers had no vote in that. The rules that sat over their money turned out to be policy, not law. That is the deeper theme running under this whole cycle. Paper arrangements, pegs, promises, and fixed prices are only durable until the people who set them decide otherwise. And gold is the one thing on the table that does not depend on anyone keeping their word. The cycle and the ratio is really just that truth playing out across the generations, over and over, in a rhythm you can now read. That is the lesson the desks understand, and you are not supposed to. The path is jagged. There was a stretch after 2011 when gold fell for years, when a mere hint from the Federal Reserve that it might slow its bond buying sent the metal down sharply in a single year, though nothing about the long story had changed. There was a bottom after that multi-year decline, and from that bottom gold began the long climb that has carried it to the records we see today. None of it moved in a straight line. All of it moved inside the same great cycle. The zigzags are where the weak hands get shaken out, and shaking you out is a business, not an accident. So here is the midpoint question, the one that actually changes how you see everything that follows. If the ratio was near 1 at the gold peak and towering at the stock peak, then where does it sit today, after this whole long climb in gold and this whole long run in stocks? The honest answer is that it is nowhere near the extreme that marked the last great stock top, and it is a long way above the low that marked the last great gold top. In plain language, measured against gold, stocks are not at a historic bargain, and gold is not at a historic peak. We are somewhere in the middle of the swing, and the direction of travel over these recent years has been the ratio grinding down, not up, which is exactly what the early and middle innings of a gold cycle look like. That is not a promise. It is a location on a map that is 50 years long. And this time, there is something underneath the cycle that was not there in the same way before, which is why I think this rhymes with the past rather than simply repeating it. In the old days, the rule was simple. When real interest rates rose, gold fell, because gold pays you nothing and a bond does. That inverse relationship held for decades, and every trader learned it. But in recent years, that rule broke. Gold has climbed even as real yields stayed high, defying the old textbook. And the reason is that a new buyer took over as the one setting the price at the margin. Not the fast money and paper funds. The central banks, buying physical metal by the ton, for reasons that have nothing to do with next quarter's interest rate. Why did they change their behavior? This is where you have to look at the world honestly. A few years ago, one major power had its foreign currency reserves frozen by other nations in a matter of days. I am not here to argue the politics of that. I am here to point out what every central banker on earth quietly concluded when they watched it happen. Reserves held as somebody else's promise can be switched off. Gold sitting in your own vault cannot be frozen by another country. It has no counterparty, no issuer, no button someone else can press. And so the buying accelerated, and it has stayed strong far above the old normal ever since. That is a structural shift, and it sits underneath the cycle like a new foundation. There is a milestone in that shift that ought to have made every front page. By the reckoning of the European Central Bank's own analysis, gold has now overtaken the euro to become the second largest reserve asset held by the world's central banks, behind only the US dollar. Think about that. The oldest money on earth just climbed back to the number 2 seat in the world's official reserves quietly, while the financial media was busy telling you about the latest tech stock. The people who run the money are voting with their vaults, and they are voting for metal. Now here is the honest caution, because I owe you that more than I owe you excitement. A cycle is a case, not a guarantee. The ratio can stay stretched longer than seems reasonable. Gold is genuinely volatile, and it can fall hard and fast for reasons that have nothing to do with the long story, the way it fell on nothing more than a hint from the Federal. There will be shakeouts on the way through this cycle that feel like the end of the world and are nothing of the kind. None of this is personal financial advice, and nobody, including me, can hand you the price or the date. What I can tell you is where the measurement sits and which way it has been traveling, and let you decide what that is worth to you. Which brings me to what a sensible person actually does with all this, and it is not complicated. Own the real thing, not a paper claim on it. Because a cycle that turns on central banks preferring metal they can hold is not a cycle you want to ride through a piece of paper someone else can freeze or fail to deliver. Size your position so that a shakeout, and there will be shakeouts, can never force you to sell at the bottom. The whole tragedy of every cycle is the person who understood the big picture perfectly and still got shaken out at the low because he owned too much for his nerves and had to sell to sleep at night. Do not be that person. Hold an amount you can hold through the jagged parts, and then let the cycle do its slow work. And now I want to tell you the part the winners understand that almost nobody else does yet. We are not standing at the moment when this becomes obvious. That is exactly the point. The central banks already know, and they are already positioned, buying by the ton, year after year. A handful of sharp private investors already see the ratio and already understand where in the cycle we sit. But the mainstream has not caught on. The pension funds have not repositioned. The financial media is still treating gold as a sideshow to the next earnings report. And that gap between what the smart money already knows and what the crowd has not yet noticed is the entire opportunity. Because by the time this leads every news segment, by the time every advisor is recommending it, by the time your neighbor is bragging about it at the barbecue, the easy part of the move will already be behind us. That is how every one of these cycles has ended. Nobody sends you an invitation to be early. Being early feels lonely and a little foolish, right up until it looks obvious in the rearview mirror. So let me answer the question in the title as plainly as I can. 50 years of data does not say gold's next move is historic because a chart is magic, or because I can promise you a number. It says it because the ratio that measures stocks against gold has spent half a century swinging between two extremes, and it sits today closer to the beginning of a gold season than the end of one, with a structural new buyer underneath it that the old rules never accounted for. That is the case. It is a strong one. It is not a certainty. And the difference between understanding it now and understanding it after everyone else does is the difference the whole cycle is built on. If you watch this all the way to the end, you are exactly the kind of person this next part is for. I hold a free, no-obligation, one-on-one educational web conference for viewers with $100,000 or more in their retirement savings who want to understand how to actually position for what we have been talking about, calmly and on their own terms. The reason to do it now is not fake urgency, and I will never insult you with fake urgency. The reason is the opposite. The best time to make a calm, clear-headed decision is precisely when nothing feels like an emergency, when you still have the room to think and choose. That window is open right now, while the crowd is still asleep, and it closes the moment everyone wakes up at once. If you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Mention that you watched this all the way through, and we will set up a time. 50 years of data drew you a map. What you do with it before the crowd arrives is entirely up to you.